Hello, listeners. Ansel here. This is part one of a three-part series on the repo market. We started recording this a couple weeks ago. We're just getting this first one out now. Be on the lookout for the next two over the next week. And that's it. All right. Enjoy. Well, what's the latest on the repo market? I mean, I haven't really read too much this week on it other than, they're continuing to do these repo facilities.
So I actually have a main link down here. So the New York Fed posted something, but I think it's Business Insider here. Let me find my points here. Yeah, forgive me while I'm trying to find my area here.
I'm doing some Googling to see.
Yeah, the pretty much the same. I mean, I can tell you just from this is a Business Insider article.
Hello, everybody. My name is Ansel Lindner. I am joined by my co-host, Kent, the master of macro melange, and we are on episode 5 of AK Global. We've been having a good time. This show is dedicated to the macro situation around the world. We've talked all about different interest rates, and we've talked about stock buybacks. And we've also talked about Japan on episode 3, so go check that out because we mention Japan all the time. But today's episode is on the repo facility that the Fed has been doing recently. And a lot of people are kind of interested in this because nobody knows what it is. Nobody understands what's exactly going on. Even people deep into finance, they don't understand what's going on. But we're going to do our best here to kind of talk about this and get it out to you guys. And then hopefully you guys have some questions for us, or maybe on future episodes, you guys can, we can answer some of your questions. Anyways, so Kent, how are you doing tonight?
Not too bad. It's getting towards the end of the week. So, the weekend is near, and that is a good thing.
Yeah, we are over the hump. We're getting close. You have big plans for the weekend? Anything?
No, the weather took a turn for the better. It's cool here now. Looks it's still really green. Summer kind of lingered late, it seems. Mm-hmm. So things are still very green. Haven't really gotten any hint of change. I'm a big fan of fall, so hopefully we get some good colors.
Well, I heard that so every year we have this polar vortex, right? And this year it actually got started a little bit early. So people were expecting it to start forming around the middle of the month. But the way that the pressure systems and everything formed up over the continental United States, the polar vortex started like a week or two early. And that's one reason why the Midwest there is having this cold snap. But usually, Halloween is when it kind of starts turning colors. But it might be earlier this year. That's interesting. So,
yeah, I mean, it was 90 and humid a couple days ago, and it was 45 this morning, I think. So,
wow.
Yeah, it's been quite a dip. But I mean, it's nice out. So, I'm not complaining. The mosquitoes were aggressive until just the other day. So.
Well, that is fire pit weather, if I've ever heard it. And for our listeners, Kent and I, Kent used to come over all the time and hang out in my backyard with the fire pit. And that was some of our really good conversations late into the night with the fire ablazing with a couple brewskis. And so that's kind of how we bonded a little bit. And then, here we're doing a podcast. So
yeah, well, that's how things kind of transpire, I suppose. But we ultimately met at the Bitcoin meetup, and that was that was really the catalyst.
Yeah, and just a note on that. So the Bitcoin price has been dropping, and I assume most Bitcoin meetups, most Bitcoin groups, and just any people's passing interest in Bitcoin or even growing interest in Bitcoin has been kind of set back by this. So it's kind of interesting that this is all happening with the financial crisis, and we have a dip here in Bitcoin. So maybe we'll get into that later. But do you want to take us into this repo stuff? What is going on? Where do you want to start? Go for it.
Okay, I think the best place to start is just to kind of describe what is going on. Really, actually, let me take a step back. A good place to start would be to just explain what the repo market is. Just got a few notes here that should kind of help the listeners understand the function of the market. So first of all, a repo it just means like a repurchase agreement. Typically, what happens, really most of the time, to my understanding, is what happens is banks lend to each other overnight. They have to have some sort of collateral, and the collateral that they use is like the U.S. Treasury because it's risk free. It's considered safe. And so the bank that needs a cash injection, that needs liquidity, what it does is it sells to another bank, or right now, in this case, the Federal Reserve, and it sells those treasuries to the Reserve, and the Federal Reserve gives them cash, and then the next day they're supposed to just basically re-exchange what they sold the previous day. That's what the overnight repo market is. The issue right now is that the Fed had to be the lender because the other banks won't lend. And what makes this market very important is the liquidity aspect. It's a market that helps the banks. I think this is like their reserve requirements, for example. If they need to meet those, they can go into the repo market and basically exchange treasuries for cash. So it's how they maintain liquidity when they don't have it. So again, the Fed has basically intervened in this market and is supplying liquidity, aka printing money. I mean, they're not literally printing, but just for ease of understanding, they're increasing the money supply by lending to these banks because the other banks won't do it. Do you have anything to add as far as your understanding of the repo market?
Yeah. So when we talk about the Fed's, I guess the Fed funds rate, this is what we're talking about, is the rate in the repo market. And the way that the Fed maintains these interest rates is because I was going back through the history of all of these different overnight repos, and it looks like the Fed, is active in these markets, just kind of tapping on each side of this market to keep it right at the Fed, within the Fed funds rate. So they could do repos, and that's where they inject money out into the economy, or they could do reverse repos where they actually sell treasuries into the market, and then they get the liquidity out of the market. But this is how they kind of manage that interest rate, which is interesting to me, that the interest rate spiked, and this kind of tells me that like they lost control. But I'm sure we'll get into this a little bit more. So that's all I had for this initial segment.
Yeah. Last question, based on what you just said, is so I know when QE was launched, which is basically a liquidity issue.
Mm-hmm.
You've got your FMOC. This, for the listeners, this may be getting a little into the weeds, but you've got the Federal Open Market Committee. What's the relationship between the repo market and what do they call it? Is it open operations? There's a term for it.
Open market operations.
Yeah, are those the same thing, or are they related? Can you elaborate on that, or do you know?
Well, the repo market is natural, and it is, these big banks, they're dealing with billions of dollars, and they have like overnight liquidity needs. So they have lots of different loans and lots of different reserves, and maybe they're trying to balance these $1 trillion balance sheets, and when one night they might be off by 100 billion or something crazy, they need to make some sort of loans to each other. And so this is a naturally occurring market, very financialized, but it is naturally occurring. But the Fed steps in through the New York Fed. That's their trading arm. The New York Fed is the biggest bank in the Federal Reserve System, and they go out there, either purchase or sell treasuries to kind of keep their Fed funds rate at a specific. So that what they're doing is they target the interest rate within this naturally occurring market. So
so they are the repo market is their medium, if you will, for engaging in things like quantitative easing. So, well, no,
yeah,
quantitative QE is a little different, but well, no, quantitative easing because they're crediting the balance sheets of the banks, if
yeah,
I remember correctly. So the
yeah,
repo market is their tool that's their medium to do that.
correct. Yeah. So what they'll
Okay.
do, like for during QE, what they said was next Tuesday we're going to buy $60 billion worth of treasuries, right? And so then what the banks would do, or what these primary dealers, the ones that the big banks that can buy treasuries directly from the U.S. government, they would front run the Fed and they would buy these treasuries early and they would get them ready and then they would sell them directly to the Fed. And they would get the difference, whatever the difference was in that exchange rate, and it would be like pumping money directly into these banks. So it wasn't initially meant to be like that, right? The QE was initially meant to uh, buy troubled assets from the banks, but it turned into just kind of like free money for the banks in the end.
Right. Okay, that clarifies that. I was just curious. I was just thinking the exact relationship between the repo market and QE. So,
Yeah, and like I
per-
said up front, that is my understanding.
yeah,
From
no, it's
I could be totally off base here, but I think I have at least a 50% grasp of what we're talking about here, and that's what I get. But I nobody really knows, honestly. I really believe
right.
that. I don't even think the fucking the economists at the Federal Reserve know exactly how this works. So
Well, I mean, they call it an esoteric market for a reason. It's very what's the word, opaque. It's unclear exactly what's going on, but ultimately, I think for the listeners, the important thing is when banks are in trouble, liquidity wise, meaning they don't have enough cash to meet the demands of their business.
hmm hmm
This is the market that they turn to in order to get that quick cash injection.
hmm
Um, and I think that's a good segue into what actually occurred. We've got a little brief timeline here. So on September 16th, the repo rate, the overnight repo rate, traded as high as 8%, which basically means that you had some banks that had liquidity issues, and the other banks just, refused to lend. And so the banks that had the liquidity issues in their desperation were basically willing to 6 percentage points higher than what the Fed funds rate was, right? So it was like the Fed fund rate, it was at 2%. I think it
hmm
was like 2.25, something like that. So the banks that weren't cash strapped refused to lend to the banks that were cash strapped. And so the banks that were cash strapped, they were essentially willing to be charged whatever rate in order to get the liquidity. September 20th, the Fed, basically a schedule came out. Since the 16th and until the 10th, they'll be doing overnight repos of 75 billion. However, in addition to that, there are these longer term 14-day repos that are 30 billion roughly in size, and in some cases those are in addition to the 75 billion. Just there's a lot going on there, and so that's basically where we are. We have some days here recently where more than 100 billion in liquidity has been added into this overnight market. That's the time up until this point. Ansel, do you have anything to add? Any thing that you've seen in addition to this?
Well, I wanted to add a little bit about these reserves and reserve ratios and stuff for the banks. So we are operating under a fractional reserve system. So the banks years ago, they had to have like 1 or 2% of their deposits. So these are people that are holding money at the bank. Those deposits, they only had to keep 1 or 2% of them in reserve. They could lend out the rest of them. And this became a really bad issue in the financial crisis because these loans that they made went bad. And so they couldn't meet the demands of their business, and they ended up starting to have trouble. Then QE came in to balance this out. So it was a cash injection to build up reserves. And then I don't know exactly what this reserve, the unofficial reserve ratio is, but they pumped in almost $4 trillion into the system, and these reserves got up to a significant percentage. Now, these banks were supposed to, use that.
Lend.
They were supposed to lend, and they're supposed to use that to carry on their business as usual. But what happened was they parked all of those reserves at the Federal Reserve. So, these banks can keep their reserves at the Fed, and they get a very small percentage off of that. Like it's like 0.5%, I think, or at the height. I think today it might be 0.25%, but it's very, very low. And so they started relying on that return. What they ended up doing was just let's get a fucking $1 trillion in reserve and just live off this 0.25% interest rate, and now it's turning out that they can't do that because of the rates around the world, and maybe some of their loans are going bad. So even with all of those reserves, their calculations don't net out. And that is why they're having to go into this repo market, because there's plenty of reserves in the system. Like you were saying, some banks have plenty of reserves where some banks don't. But there's plenty of reserves in the system to go around. The problem is there's some banks that are not a good credit risk. And so big banks will not lend to other big banks. So what does the Fed do? Well, the Fed is the lender of last resort, and the Fed will come in and rescue this situation when no one will lend to this crappy bank that has all this shit, these shitty assets on their books. Somebody's going to have to lend to them, and that's going to be the Fed, right? So that's
nobody wants. I mean, mortgage-backed securities are still sitting on people's books. Those are. I mean, I'm going to assume that those have massively increased in nominal value just because they're tied to the housing market, which has been,
going up
sky high.
Yeah.
But they're going to implode again. They're hollow. One interesting thing I wanted to, just a quick excerpt I wanted to read from an article. This was on from Real Investment Advice last week, written by Michael Leibowitz, and covers a lot of these things. So I like a lot of his analysis. He has a paragraph in here where he says, on September 16th, overnight GC repo traded as high as 8%, almost 6 percentage points higher than the Fed funds rate, which theoretically should keep repo and other money market rates closely tied to it. The billion-dollar question is, why did a firm willing to pay a hefty premium with risk-free collateral struggle to borrow money? Before the 16th, a premium of 25 to 50 basis points, so a quarter or a 0.5% versus the Fed funds, would have enticed a mob of financial institutions to lend money via the repo market.
Mm-hmm.
On the 16th, many multiples of that premium were not enticing enough. Just kind of piggybacking on your point there, what he was making the comment. It's just strange. Very strange that at one moment getting a little bit of additional yield and they're willing to loan, but all of a sudden, no amount of yield in the world would get them. So that definitely something going on.
Yeah, there's this one Twitter account, the Stalwart, Joe Weisenthal. He challenged me and this other guy. This was several months ago. And he's like, well, no, the Fed doesn't set interest rates. What is that process of the Fed setting interest rates? And it's a hard question. I mean, very few people in the world can just rattle off an answer. But now that we have this repo situation, I think that number is growing dramatically. So what happens is the banks, like you've said in previous shows, they borrow short and they lend long, right? Well, the shortest is the overnight repo market. That is the shortest end of the spectrum. And so that is the basis for the rest. So your point there was, or Leibowitz's point, whoever said that, was if the shortest end of the spectrum is 8%, Like the rest of the spectrum should be way above that. And that it's not, that it didn't follow that. That's, or that it was stopped by the Fed from going there. Like that would be healthy, actually. Like it would be healthy if the interest rates shot up right now. It would clear out a lot of the market, liquidate a lot of bad loans and all these things.
It would annihilate the market as it currently stands.
Yeah, but
which isn't bad, but it's yeah.
Yeah, but the Fed isn't letting that happen. I don't know. There's probably some sort of illness analogy that you could make here. You know, you're not with addiction or whatever. You're not letting that withdrawal happen. You are feeding the addict more meth or more heroin or whatever. And so that's what the Fed did. Basically, when it comes down to like a layman's definition, what the Fed is doing here is the Fed rushed in with a bunch of heroin into the market real quick to try to save this whole thing, right? That's not a good sign.
Yeah, well, even as far as I understand, this repo fiasco, what happened was that the Fed funds rate actually got away from the Fed where they couldn't control it.
Mm-hmm.
But ultimately, when the Fed engages in policy, it creates incentives. They don't set the rates per se. They try to set the rates because ultimately, by adjusting the reserve requirements of banks, they're hoping that the banks behave in a certain manner. They give the banks more reserves so that they have more to lend. But if the banks don't see anything out there that's feasible or profitable, I should say, they're not going to lend. And I think that's one of the problems that we're running into, hence the liquidity issue, right? Mm-hmm. These banks don't want to lend. So, of course, the rate's going to get away from the Fed because the banks aren't playing ball. They're not really doing what the Fed thinks they're going to do when it tinkers with their balance sheets.
Well, yeah, so their normal open market operations, I would say maybe $500 million or $1 billion or maybe even up to $3 billion a night. This is just what they normally do. Sometimes they inject liquidity into the market. Sometimes they take it out. I would say on net, other than QE, right? Because their balance sheet isn't supposed to grow normally. So on net, it's zero. But every day they're kind of tinkering with this repo market, trying to keep it steady. They can't like say 100% we're going to keep it right here. So yeah, anyway, that's all.
Yeah, I wish I would have pulled up this article. I can't remember the exact numbers and it's going to bother me, but between 2003 and 2007, going up to the financial crisis, the Fed's balance sheet, it only grew by like $250 billion or something like that. And this repo madness has actually already exceeded that in a matter of days. So it took a couple of years, beginning about 15 years ago, has been done in a matter of days. It was just an interesting aside that I saw that I wish I could find the article, but I think it's very telling that they're rapidly losing control. As far
it's they're upping the dose of heroin because the patient was starting to stroke out during withdrawals, and like if you look at the balance sheet chart, they were trying to decrease the balance sheet just last year, and the patient started stroking out 2 weeks ago, and so they pumped in more heroin. Right, that's kind of what I'm thinking. Is that meshing with your analysis of this?
Yeah, I mean, it's like the hits that it took to get the attic high, 15 years ago were just so paltry compared to today. Now to keep the heroin addict high, it's like I remember when Kurt Cobain, committed suicide or whatever. I don't know what happened. I'm not going to get into that topic, but I'm just going to go with what supposedly happened was he got loaded up on like 13. He shot up like 13 grams of heroin, which is that's unreal. You could kill yourself with a gram if you weren't careful. And then he shot himself or whatever. And so it's like in order to have a tolerance to even like sustain that, it would take a while to get there. But it's the same thing,
Well, that's. First off, it's a great podcast when we're talking about Kurt Cobain. Second is no, that's interesting because like what is market suicide right now?
Well,
Um,
they're
a
overdosing.
trade.
They're going to overdose. I mean, that's
Yeah,
yeah.
yeah, but what is the actual gun? I mean, is it a trade war? Is it like some sort of um, bank buying a bunch of gold? I mean, there's got to be some sort of gun that kills this patient because it is true that the patient can keep going and going and going, and maybe the Fed's balance sheet is 40 trillion before we know it. But eventually, somebody's going to shoot the system in the head. You know what I mean?
Yeah, I mean,
What is that? Is that a bad analogy, or what is that going to be here?
that's a good question. I mean, you can point to a lot of different issues. I can only say what came to mind. This is what came to mind. Uh, Mises talks about malinvestment, and
Yeah.
what's happening is, it's like diverting a river or something over a town. See, like, I don't know why you would do that, but you destroy the town if you diverted the river over it. And so that's kind of what's happening here is with all this debt, they're diverting resource streams to destructive uses. And so eventually, we're going to reach a point where it's like, oh my goodness, like all the
All our capital's
yeah,
gone.
the resources we need to survive are have been destroyed by this mechanism, this inflation, because it's going parabolic. That's I think what's going to eventually cause the collapse. Safety covers a lot of this stuff really well because he talks about the effects of like time preference in relation to inflation, and even goes
Hmm.
into like cultural stuff like bad art and bad food, you name it.
Hmm.
And it's just really interesting. And I don't want to go too far off on the tangent here, but he has a little point where he ties in like just society and like existence in relation to unsound money and the high time preference it
Yeah.
creates. And it's like philosophical, really genius stuff as far as I'm concerned. Uh,
Well, if you're interested in that, check out Guido Holzman from the
Mises,
Mises
yeah,
Institute. Yeah. He has a book called The Ethics of Money Production. And I think that's where Safe got a bunch of his stuff from,
probably.
because it's about 10-year-old book or so. And it talks all about how easy money inflation actually degrades culture and degrades society because it makes everything so high time preference.
Yeah, Safety made a comment. He said, like when we were in our primitive state, for lack of a better term, living in caves and, not knowing where our next meal is going to come. That's a very high time preference sort of lifestyle because that's the only way that you can survive. Savings, being able to maintain like a pool of capital, you need that in order to start planning for the future, or whatever. But if you're too worried about, what you're going to eat meal to meal, you don't have time to save things, and ultimately civilization can't grow because everybody's just immediately burning them in order to
Right.
live to see another day. And so what's taken us out of that primitive state is saving, literally saving resources so that we could pursue more efficient ends. For example, Peter Schiff has that book called How an Economy Grows and Why It Crashes, and he has the example of the fisherman. And initially, the guy, if I remember correctly, the guy is just like spearfishing. And then eventually he decides, well, I'm just going to eat less of my fish, and he builds a fish trap. He used to fish for 8 hours a day, but then he had to consume less in order to partition half of that day, make the fish trap.
Hmm.
But it yielded better
Hmm.
results in the long run because he was able to grab way more fish, which made his life easier. He was able to accumulate capital. You can keep building on that. Anyway, that was a bit of
Yeah.
a set
So
aside
how
here.
do we? No, that was perfect. So how do we tie this back into the repo market and the bad assets on all these banks' balance sheets? One thing that I thought of when you were talking there, I think it was before this last point, but so the degradation of your capital. The financial system is built on debt, right?
Mm-hmm.
So these banks, their assets are loans. And so, like, let's say the best loan is AAA. That means you can be pretty guaranteed that they'll pay it back. The risk free rate, of course, is the US Treasury, but eventually all of that capital, all of those assets, those loans will be bad. That means everything of the system that we've built up over the last 100 years, that's built on debt, trillions and trillions and trillions of dollars of derivatives and all of these things, it's worthless.
Well,
It's gone.
Yeah, because
Right?
we're destroying our capital pools ultimately.
Sorry, I lost my train of thought there. I lost my point. Was that so right now we could say, yeah, our capital is represented in this debt. That is actually our capital. It's an asset for somebody. But all of those assets that were supposed to be our capital that we've accumulated over 100 years are worthless. It's zero. And this whole time we've been just eating away at this, right?
That and we're borrowing from the future as well, where we're pulling consumption, forward through this process as well.
Well, what do you think about this idea? I think we're beyond that point. It's mathematically almost guaranteed that we can't pay it back. So at this point, I think people know, like deep down, even these big bankers, all of these government bureaucrats and big time investors, people that run hedge funds and all this stuff, they know in their heart of hearts that all of these things will be defaulted on, but they're just kind of like praying. So they're not borrowing from the future anymore. They're kind of borrowing from their own future because they're just extending far enough. They know it's going to collapse at some point in the near future. What do you think of that idea?
Well, to piggyback on that, I do know that the deficits that the government is running, are running, I mean, they're historically large. And apparently, just like you saw in the repo market, certain banks did not want to lend to other banks. Well, people don't want to buy that debt from the government. So there's going to be a huge issue of these treasuries, and probably going to be a complete lack of liquidity, which means only one entity is going to step in to the tune of whatever it is, 1.3 trillion, I don't know. And it's going to be the Federal Reserve. And so, like you said, yeah, there's just it's just going to be parabolic debt. It's like, it's all these paper assets. They mean nothing. There's like 1 billion claims to like a bar of gold. I mean, it's ridiculous, to the point where I'm like, are people just going to barter? Because, like, you can't eat this digital money or whatever that they create. You can't really do anything with it. It has no actual use. So, are people just going to go back to basic barter, or I give you a piece of wood to build your house in exchange for a chicken or something? I mean, this is actually where I think Bitcoin is going to come in and facilitate a proper medium of exchange, because our current global monetary system has failed us. But we could very well see some sort of barter arrangements due to what's going on right now.
Yeah, I think we could see short-term and local barter type economies in inner cities or something like that. But I think on a aggregate global scale, I don't think barter would be. I mean, we'd if we zoomed out, it would be gold and silver or Bitcoin. I don't know if this financial crisis is the one. And I mentioned this several times. I don't know if I've talked about this on this show, but I've mentioned this several times. I don't know if this financial crisis is the one that gets Bitcoin, but it's this one or the next one. And I agree with you that these people they're going to wake up one day. All these people with billions and billions of dollars, they're going to wake up and they're going to say, hey, let's not pretend anymore. Let's default on this shit, right? Give me the gold. Give me the Bitcoin. Right now, I think they wake up and they're like, we can extend and pretend this a little more. I really do believe it's starting to dawn on everybody, all these professionals, that we can't keep it stable anymore. I think it's worse than 2008. I think you would agree with that,
yeah.
Right?
Yeah, much worse.
That's it for part 1 of this repo talk. We continue it in part 2, so subscribe and look out for that. All right, see you guys.